Hi everyone, welcome to the Real Estate Tax Tips channel. My name is Cherry Chen, a chartered professional accountant located in Oakville, Ontario, Canada, and I'm on a mission to become the Google Map for hardworking Canadians seeking financial freedom. And today's topic is RRSP contribution, Registered Retirement Saving Plan contribution. Now, what is it and why we need to talk about it? Because the contribution deadline is coming up. It's on February 29th, and so this is the perfect time to talk about the RRSP tips and tricks for 2024. But before I get started, make sure you hit the subscribe button and give us a thumbs up if you like our video. Now with that, let's get started. RRSP, or Registered Retirement Saving Plan, is one of the biggest pillars in the Canadian financial planning world. To understand RRSP a little bit better, the RRSP is a retirement saving plan that's been a part of the Canadian life since the late 1950s. It is a government-approved plan designed to encourage us to save for our retirement. The beauty of an RRSP is that it not only helps us save, but also offer a significant tax benefit, which we'll explore in detail. Now, when RRSPs were first introduced, the idea was simple: giving Canadians a way to save for retirement while reducing their taxable income in the current year. Now, over the years, it has evolved and become an integral part of retirement planning. An RRSP is essentially a saving account with a twist. You can put money into this account, and that money can be invested in various forms of financial instruments like stocks, bonds, mutual funds. And for those of you who are real estate investors, a lot of you have invested in private lending, land development deal within your RRSP environment. But unlike a regular saving account, the money you contribute to the RRSP is tax deductible. This means that you can deduct the amount you contribute from your taxable income, reducing the amount of tax that you need to pay immediately. Now, but that's not all. The investments in your RRSP can grow tax-free as long as they stay in the plan. You won't pay any tax on the investment returns, be it in interest, dividend, or capital gains, or even the return of investment or the profit that you make from investing in these land development deals. You don't have to pay any tax until the day you withdraw the money, which is usually during retirement. So why is this important? Because ideally, when you retire, your income will be lower than during your working years. This means that when you eventually withdraw from your RRSP in retirement, you'll be taxed at a lower rate compared to the rate during your high earning years. In essence, RRSP is not just a saving vehicle. It's a strategic tool for tax planning and retirement preparation. It's about saving now and reaping the benefits later, both in terms of savings and tax efficiency. We've just scratched the surface of RRSP. Now, in the next section, I'm going to dive a lot deeper into the contributions, withdrawal, tax strategies, and everything. Now, let's get started. So how does RRSP work? Well, now that we understand what RRSP is, let's talk about the contribution, the cornerstone of building your retirement saving. Making contribution to your RRSP is where the real tax magic happens. Each year, you can contribute to a certain percentage of your income to your RRSP. This limit is set at 18% of your previous year's earned income, up to a maximum amount set by the Canadian Revenue Agency. Now, this limit is adjusted annually to account for inflation and other economic factors. But what if you don't contribute the full amount? Well, the unused contribution room doesn't just disappear. It gets carried forward indefinitely. This means that you can use it in future years when your income might be higher and the tax deduction could be more beneficial. Each year, your RRSP contribution room is calculated based on the previous year's unused contribution room, plus 18% of your earned income. And what's earned income? Earned income includes salary, the rental income that you earn, but dividend income is excluded. For 2024, this limit is $31,560. It's important to note that your contribution room can also be affected by pension adjustments, which occur if you are part of an employer pension plan. So these adjustments reduce the amount of RRSP contribution room that you would be entitled to because you're already accruing retirement benefits through your employer's plan. Now, before making any contribution, it's important, crucial, to refer back to your previous year's notice of assessment. This document outlines your available contribution room and ensure that you stay within your limit. So contributing more than your allowable room can result in overcontribution penalties, and you don't want to trigger those penalties, trust me. And speaking of the penalty, if you overcontribute to your RSP, there's a 1% monthly penalty on the excess contribution amount. And this penalty is calculated based on the value of the overcontribution and is applied every single month, 1% every single month. If you multiply that by 12, it's like 12% a year, so it's a lot of money. And it's being compounded as well. Let's say you earned $100,000 and contributed Let's say you earned $100,000 and contributed $10,000 to your RSP. For tax purposes, your income would then be considered as $90,000. $100,000 minus $10,000 RSP contribution. Now your taxable income is $90,000. Now this reduction in taxable income will lower your tax rate, will lower your tax liability, given that now you have a smaller amount of taxable income to be subject to tax. Now, it's important to remember that there is a fine line to walk here. While it's tempting to contribute as much as possible to reduce your current year's taxes, you should also consider your future tax situation. Will your income be higher or lower when you retire? This is crucial in planning the timing and the amount of your RSP contribution and also deduction. One of the most common myths about RSP contribution is that people think that if they have a tax liability owing of $10,000, all they need to do is to contribute $10,000 RSP to completely eliminate the entire tax payable balance. But this is a common myth. Now, let me use an example to explain. Now, let's say for someone who makes about $100,000 annually, this person is going to subject to various tax bracket. And in Ontario, the way that we calculate, and actually in Canada, across Canada, the way that we calculate the tax liability is based on the tax bracket and multiplied by the corresponding marginal tax rate, and we sum them all up at the end to come up with the tax liability. For someone who make $100,000 in 2024, the total tax payable would have been $21,658, roughly, because we're making a lot of assumption. This is just a basic calculation. Now, let's say this person is going to sell property, and this will give him about $100,000 capital gain. As we all know, that $100,000 capital gain, 50% is taxable. The other 50% is non-taxable. Now, this $50,000 that's taxable is going to be added to this particular individual, this taxpayer's $100,000 regular salary, so resulting in $150,000 of taxable income. Now, for this particular person to earn $150,000 of income, the additional $50,000 of income is going to subject to 38% tax to all the way to 43% tax. So the additional tax being added would have been added on top of the $100,000, and this person would have to pay quite a bit of additional tax, roughly about $20,000. For this person to sell the property, the additional tax that this person would have to pay is about $20,719. So this would have been what happened. The most common misconception among our client is that they would think that if you contribute $20,000, because the additional tax liability by reporting an additional $50,000 of income would be $20,000. If this individual contribute $20,000, they are often under the misconception that by contributing $20,000, you would be saving the entire $20,000 of tax payable. But the reality is that RSP contribution is really only deducted from the top of your tax bracket. The way that you can calculate the amount of tax reduction by contributing RSP is by taking your RSP contribution, which is $20,000 in my example. This person is going to contribute $20,000. Take the top marginal tax rate, and the top marginal tax rate in our example is the $150,000 tax rate. which is 43.41% for that particular tax bracket. So you take that tax on the top marginal tax rate, which is 43%, multiply by the RSP contribution amount of $20,000, it results in a tax saving of about $8,682. So obviously, it's very different from the additional tax liability that this person would be paying, $20,000, and if you contribute only $20,000 in your RSP, it would only save you a fraction of that amount, a fraction of the contribution amount, and resulting in an additional in this example, an additional $12,000 of tax payable that you would have to pay, unfortunately. So it is also very important to make sure that you speak to your professional accountant to understand the actual amount of RSP contribution that's required in order to completely eliminate the amount of taxes that you would have to pay, if that is one of your objectives. Okay, tax benefits of RSP. First off, the most immediate benefit of contributing to a RSP is the reduction in your current taxable income, as shown in our early example. As I mentioned before, every dollar you put into your RSP is deducted from your income for tax purposes, but not against your tax liability. Deduction against your income. This can result in a lower tax bill in the year of your contribution. But there's more. The money in your RSP doesn't just sit there, it grows, and here's the best part. This growth is tax deferred. This means that any interest, dividend, land development deal profit, capital gains earned on your investment in the RSPs are not taxed as long as they remain in the account. Think about it. No capital gain tax, no tax on interest, and no tax on profit, and no tax on dividends. This allows your investment to compound over time without the drag of taxes, which can significantly accelerate the growth of your retirement saving. This tax deferral continues until you start making withdrawals, typically in retirement time. By then, your income is likely to be lower than during your working years, meaning you'll be taxed at a much lower rate. This strategic timing can result in overall tax saving across your lifetime. Now let's talk about withdrawals from RSP. Now that we've covered how RSP contribution works and then their tax benefit, let's talk about what happens when you start withdrawing from your RSP. This is a crucial part of your retirement strategy. Firstly, it's important to know that withdrawals from your RSP are taxable. When you withdraw funds, the amount is added to your income for the year and taxed at your marginal tax rate. This is why many people wait until retirement to withdraw from their RSP when their income and potentially their tax rate is much lower. There are, however, certain circumstances where you can withdraw from your RSP without immediate tax implication through something called, like for example, home buyers plan and lifelong learning plan. You're only allowed to withdraw for the respective purpose in order to avoid triggering immediate tax implication. Now, the home buyers plan allows you to borrow funds from your RSP to buy or build your first home. The lifelong learning plan lets you fund your or your spouse's education. These programs are essentially interest-free loan from your own RSP to yourself. You'll need to repay the amount over a period of years, but it's a great way to leverage your RSP for important life goals. Now, what about early withdrawals? Withdrawing from your RSP before retirement can have significant tax implications. Besides the immediate tax hit, you also lose a contribution room forever. This is why early RRSP withdrawals should be carefully considered. We're going to talk about an example later on in our tax strategies about why you would consider early withdrawal of your RSP to save taxes. Now, as you approach retirement, you'll need to convert your RSP to something called Registered Retirement Income Fund, RRIF, RRIF, or purchase an annuity. This transition is about turning your savings into a regular income stream for your retirement years. RSP at retirement. As we move into the golden years of retirement, managing your RSP becomes crucial. In this section, we'll explore what happens to your RSP when you retire and how to strategically plan your withdrawals. First, it's important to know that you must convert your RSP by the end of the year you turn 71. You have to convert it to RRIF that we mentioned earlier. You have a few options for this. You can convert it into RRIF, you can purchase an annuity, or taking it all out in cash, although the latter can have significant tax implications. Most retirees opt for a RRIF, which functions similarly to essentially RSP, but with a minimum withdrawal requirement. So every year you're forced to take some amount of money out from your RRIF account. There is a minimum. You have to take it out because the government is helping you to plan for your eventual death. These withdrawals are taxable, but since many retirees have a lower income than during their working years, the tax hit is usually less severe. If you choose to purchase an annuity, your RSP is used to buy a product that provides you with a steady income stream for a set number of years or for life. The payments you receive are a combination of principal and interest and a tax as income. So it works very similarly to a RRIF. A key strategy in retirement is planning the timing and the amount of RSP or RRIF withdrawals. You want to balance your need for income with the goal of minimizing your tax burden. This may involve withdrawing more in years when your income is lower and less when it's higher. Remember, the goal of your RSP was to save for retirement and defer taxes. Now in retirement, it's about strategically managing those savings and the associated taxes. Now that we cover retirement, let's talk about what you can invest in within your RSP and what's prohibited investment. Let's explore the types of investment you can include in your RSP and what's strictly off limits. Knowing these rules is crucial to ensure that you're making the most of your retirement savings without incurring any penalties. Now, what are the qualified investments? Well, RSPs allow for a diverse range of investment options. You can invest in stocks, bonds, ETFs, and mutual funds listed on recognized stock exchange. GICs are acceptable, and saving accounts are also safe choices. For those looking into alternative investment, options like private lending and land development deals are also permissible, provided that they adhere to the CRA guidelines. However, it's essential to ensure that these investments meet the criteria for qualified investments to avoid any penalties. Now, on the flip side, what is not allowed within your RRSP plan? Well, there are certain investments you must avoid within your RRSP. These include debts owed to you, so you cannot issue a promissory note to yourself via RRSP, or investment in entities where you hold a significant interest. So Cherry's RRSP cannot invest in Cherry's accounting practice. What is considered significant interest? For example, pretty much anything that's over 10%. So you would not be able to use your RRSP money invest in a corporation that you own over 10%. That's prohibited investment within your RRSP plan. Also, any investments that are not at arm's length are prohibited generally. This includes certain shares or interest in corporations, partnerships, or trusts where you have considerable influence. Pretty much anything that's directly related to you that you have an influence on, they are off the limit. Now, if you did make some sort of prohibited investment, the penalty is pretty high. The penalty includes something called an advantage tax. And if you hold a prohibited investment in your RRSP, you're subject to this advantage tax. This can be as high as 50% of the value of the prohibited investment. If you invest $100,000 in a corporation that you own more than 10%, that $100,000 is considered prohibited investment, and the advantage tax could be as high as $50,000. It's a hefty price to pay and can significantly impact your retirement saving. Therefore, it's crucial to be vigilant about the investments you hold within your RRSP. Okay, so now that we covered so much, we talk about the tax benefit, the tax deferral, and the withdrawal of RRSP, you may wonder, hey, when I withdraw the money, I still need to pay tax. Can you really save taxes with RRSP contribution? Is it still worth it to do RRSP contribution? This is often the most asked question about RRSP within our clientele because we are all about real estate investing, and RRSP does not allow you to contribute. RRSP does not allow you to own any real estate investment directly within the plan. So many real estate investors are hesitant to make the contribution to RRSP because they will not have the funds available for them later on for buying a house. If you're one of those people that are wondering, is it worth it to contribute to RRSP? Does it really save tax? Here's the answer for you. It's a common belief, but the truth is, it's a common belief that you would be able to save taxes. It's all purely built on the fact that you're saving the taxes immediately when you are in your prime years, and then when you draw the money out from your RRSP, you'll be in the lower income tax bracket and therefore you'll pay less tax. That's all the common belief. Whether you actually would be able to save money really depends on your future income, what you are thinking that you will be earning in the when you retire. The real benefit of RRSP comes into play based on your retirement income. If you expect to be in a lower tax bracket when you retire than you are now, contributing to RRSP for sure can lead to significant tax saving. Here's why. By putting money into your RRSP during your higher earning years, you defer taxes on that income until retirement, when your tax rate is likely to be lower. If your retirement income is about the same as what you are currently making, in this case, you might not save on any taxes at all. You're simply deferring them, as you'll be taxed more or less at the same amount of tax rate when you withdraw from your RRSP in your retirement age. So there is no tax saving if essentially you're making the similar amount or similar level of income during retirement as compared to right now during your prime year. Now remember, RRSP aren't just about tax saving, they're about planning for your financial future. So understanding your potential retirement income is key to making the most of your RRSP. In this final section, let's uncover these lesser known strategies to use RRSP for tax planning. These tactics can help you make the most of your RRSP's potential. Number one is spousal RRSP contribution. First up, spousal RRSPs. You can contribute to your spouse RRSP and claim the deduction on your personal tax return. This strategy allows you for income splitting. In the future, when your spouse withdraws these funds, the income will be taxed in their name, not yours. It's a great way to take advantage of the lower tax brackets if your spouse has lower income. However, keep in mind that there is a 3-year attribution rule. If your spouse withdraws the funds within 3 years of your contribution or any contribution, if you continue in year 1, you contribute 10,000, year 2, you contribute 10,000, year 3, you contribute 10,000. On year 4, your spouse wants to take money out from the initial 10,000 that you put in, there is still attribution rule because everything got mixed up. In year 1, if you contribute to your spouse RRSP for 10,000, you stop for year 2, you stop contributing for year 3, you stop contributing for year 4. On year 5, when there are no activities for 3 years from you, on year 5, when your spouse withdraws the initial $10,000 that you contribute, the money would not be attributed back to you to be reported as the income. It will just stay with your spouse, and therefore allowing the spouse to report the income and pay the lower amount of taxes in year 5. So there is that 3-year rule that you need to be aware of, but essentially it could work. The spousal RRSP contribution could work as an effective income tax splitting rule with your spouse. Number 2, early withdrawal for income splitting. We mentioned earlier, generally speaking, a lot of Canadians will save until when they retire, then they slowly withdraw the money from their RRSP. Well, one of the ways that we plan and when we work with our clients is to look at their particular situation. And I still remember clearly as one of our clients was about to leave his job full-time and turn into a self-employed person and start his own business. And in the year that he is turning himself into a business owner, he was offered a large amount of pension transfer directly into his RRSP, but with that pension transfer, it triggered a taxable event, so he's being taxed on the pension that he was receiving from his former employer. And we had a discussion. We decided to make sure that he contribute to his RRSP to lower the amount of taxes that he would have to pay, because in that particular year, he also earned a large amount of salary and then plus the pension income. And by contributing to his RRSP, even though he doesn't want to, because he wants to invest all his money into his next business venture, which involves real estate, and therefore he would not be able to use the next investment as a qualified investment within RRSP. Our RRSP would restrict the type of investment he is allowed to invest in. So from there, we still advise him to contribute to his RRSP account to lower his immediate year of taxes, because we knew that when he start his new business in the new year, he's not going to make income or substantial amounts of income for a while. So by contributing to his RRSP in year 1, he get to pay way less tax in year 1. And in year 2, instead of waiting until when he retires to withdraw the RRSP, in year 2, we recommend him to take the money out because he has no income. So therefore, playing to smooth out his income and lower his overall tax liabilities in multiple years. So this is a good example when you would trigger the early withdrawal for income splitting purpose. You're essentially splitting income between you and your future self. Lastly, RRSP meltdown strategy. For the purpose, a lot of people don't talk about the tax implication when you pass away and you have $1 million sitting in your RRSP. If you pass away and you have $1 million sitting in RRSP, assuming that your spouse also passed away before you, and this RRSP $1 million is being taken into income the year that you pass away. So it's always problematic to have a large amount of RRSP balance sitting in your RRSP plan or RRIF when you pass away. And that's the reason why a lot of financial planners come up with something called an RRSP meltdown strategy. These are used when you have a large RRSP and face potential high taxes upon passing away. Financial advisors use these strategies to gradually withdraw from the RRSP and invest in a more tax-efficient vehicle, reducing the potential tax burden for your estate. It's a sophisticated strategy that requires professional advice to implement correctly. So make sure you can consult with a financial advisor or an accountant that knows this type of strategies before you implement it. RRSP offer more than just retirement savings. They can be a powerful tool in your tax planning toolbox. But remember, it's important to consult with a professional accountant to ensure that these strategies align with your personal financial situation. Now, as we wrap up our discussion on registered retirement saving plans, we've covered a lot, and it's crucial to remember to give us a thumbs up if you like our video, and if you find it useful, make sure you hit the subscribe button below and stay on top of the latest tax tips. Lastly, RRSPs are not just a retirement saving tool, they are a versatile financial instrument that can significantly impact your tax planning and wealth management strategies. Remember, the deadline to contribute to your RRSP is February 29 for the contribution to count toward your 2023 tax return. So if you don't care about that, having a deduction in 2023, don't worry, you can still continue to contribute throughout the year. Now, until next time, happy Canadian real estate investing.